Welcome to Philip Roundtable. My name is Kim and I'll be the host for your session today. Today we are honored to have three speakers with us. Mr. Ang Beng Guan, the Executive Director, Head of Fund Management from Hong Leong Asset Management, Encik Razif bin Rahim, the Fund Manager of Hong Leong Asset Management, as well as Dr. Tan, Founder and Chief Strategist of Firm Asset Management Sdn Bhd. Allow me to introduce the profile, the background of our speakers today. Our first speaker is Mr. Ang Beng Guan. Mr. Ang Beng Guan joined Hong Leong Asset Management in February 2021 and was transferred to Hong Leong Islamic Asset Management on 3rd September 2021 as Head of Fund Management. Mr. Ang has more than 8 years experience in global treasury markets, dealing with money market, forex and derivatives. He was a fund manager and investment strategist for institutional buy-side investors, managing close to 1 trillion ringgit in asset under management. He also spent over 4 years in capital markets, driving private debt corporate restructuring and commercial real estate private debt funds and managing emerging market public debt portfolio. Mr. Ang holds Bachelor of Science in Biohealth Sciences and Masters in Economics from UCM Malaysia. He had completed the Leadership Development Program from National University of Singapore in 2018. He holds a PKMC license and has obtained his CMSIL license from the SC since 7 May 2021. Our second speaker is Encik Razif bin Rahim. He holds a bachelor degree in finance from UiTM. He joined Hong Leong Islamic Asset Management in April 2021 as an equity fund manager. He began his career as a dual license dealer and has more than 10 years experience in the fund management industry. Encik Razif obtained his capital market services representative license from the SC since 16 November 2011. Encik Razif is a designated fund manager of HLDM, HLDM2, HLIIMF, and HLDAIZ. Our third speaker is Dr. Tan Chong Kei. He's the founder and chief strategist of Firm Asset Management Sdn Bhd. He founded Firm Asset Management Sdn Bhd Malaysia and Firm Asset Management Asia Private Limited Singapore in 1994 and 1995 respectively, after successfully helping others to build their fund management business for 18 years. He's a veteran fund manager in Asia with more than 47 years of investment experience, fine-tuning value investing alongside his innovative investment philosophy of never fully invest at all times, which successfully weathered through major crises and volatile ASEAN market and substantially increased the wealth of clients in the long run. An award-winning entrepreneur and well-respected fund manager reputed for his acute sense of market timing and stock selection, Dr. Tan was labeled as the king of the second board in 1995 and 1996. He was named the Southeast Asia's small cap king in a Bloomberg article in August 2006. In the World Wealth Creation Conference held in Singapore in 2017, Dr. Tan was named the Warren Buffett of Asia for being truly enhancing value investing. Dr. Tan was also granted the National Outstanding Entrepreneur's Lifetime Achievement Award by the Kingsley Strategic Institute for Asia Pacific in March 2021, as well as the 2022 ASEAN Distinguished Entrepreneur Lifetime Achievement Award at the 2022 ASEAN Leadership and Partnership Forum in September 2022. In Chinese astrology, dragon, the only mythical creature among the 12 zodiac signs, is known for its strength, vitality, and ability to overcome challenges. And the wood element signifies growth, expansion, and flexibility. As the wood dragon year unfolds from 10 February 24 till next year, January 25, it's believed to be auspicious, offering countless opportunities for growth. Perhaps we can start with Mr. Ang. Are there any opportunities that you see in the wood dragon year? Perhaps we can start from the US market. We all know that the US market has done very well in 2023 and has done fairly well in January and February, supported by some strong corporate earnings and data suggesting a soft landing for economy. And hopes of imminent rate cut also boosted the sentiment, but such hopes were dashed by the Fed in the January FOMC meeting month, and now we see inflation remains sticky with the Jan CPI remains elevated. What's your view on the US market, Mr. Ang, and whether it's a good time to position in the US market right now?
Okay, thank you so much. I think my name starts with an A, so I'll begin with the alphabetical start of it. For the US market, right, so basically is that what we think that the the market has continuously defied us. I mean, in terms from the economist point of view to us at the investment side of it. And I remember back in earlier 2023 that we think there would be a recession, a great recession that would befall on the US side of it, right? But eventually, as the months goes by and months turns to year end, right? So we figure out that the US market has done resiliently well. I mean, what's the secret sauce to it, right? They hiked so many interest rates, right, on the Fed funds policy rate up to 5% for close to 0%, right? And basically, how do they manage to eke out a lot of some of the growth there? And one of the main things that when we scroll that time, right, when you look into details, and most of the time, right, the growth comes from the labor market. I think there's so much slack that the Fed has given us a lot of hints stating that basically there's so much labor market gaps, there's so much labor market slacks between the demand and the supply. And when we fall down in detail, right, what is the drivers for that labor market? It's because most likely is the small and medium business side of it that has been accumulating and gathering a lot of labors and hiring that specialist engineers that have been retrenched from the big companies, right? Because there's a lot of innovations, there's a lot of tech startups, right, on the small to medium side of it, especially those companies that has less than 75 employees, so that they have been actively recruiting people into their fold, and basically that held the labor market quite well there. And in terms of the inflationary side, I think inflation has decelerated a lot already. And basically is we can see that if it's continue on this trend, right, we could see that the Fed might consider easing. Although the Fed on January FOMC meeting, they kind of like retained and tried to moderate the market expectations of an earlier rate hike, stating that they need more good data going forward, right? Because 3 months they have, not to say that they don't have any good data coming in, they have 3 months of good deceleration of inflation numbers. And basically you can see some of the services wage, and if the oil prices still retains and started to stabilize at that level, shelter prices have been coming off because there's a lot of commercial properties and mortgage tightening over there. So basically we can see there's over the next coming 3 months, we could see there's further stabilization in terms of US headline and core PCE as well. So all in all, we think that yes, the Fed funds might be having an easy, and FOMC might consider cutting, but we might see the rates at this level for quite a prolonged period. I mean, potentially, because I think the Fed is still waiting for more evidential data or more conviction in the inflation numbers and whether the economy has really slowed down to what they are looking at substantially, at least for the inflation to come down back to their long-term average inflation rate. So I leave it at that for other panelists to chime in. Over to you. Thank you.
All right. Thank you, Mr. Ang. Dr. Tan, what's your thoughts on US market? Is it a good time to position in the US market right now?
I thought it's Rajiv first. Okay, anyway. Yeah, I think US, if you take a look at last year, it's very interesting, last year. If you sell US and you go Asia because Asia is undervalued, I think you are in deep trouble. Then if you are so bullish in Vietnam last year, Vietnam really got a big hit, So what I'm trying to say is that also, while we are all guessing, I think sometimes investment has no logic. But if you go by the logic, you go by the value investing, US is definitely not cheap. US market PE is like all-time high, Yeah. Or among the highest, Yeah, you can go back as far as even just before 1930s depression when it was very high because the earning was low at that time. They push it up. US market PE today, depending on which index you use, you're actually selling around 22, 23. And US normally don't sell at such a high PE. But saying that, they're also growing. They also have very many good companies. But if you look at value investing, of course we are cautious. If I'm in US, I definitely will reduce my equity exposure if you go by the value investing. If you don't do that, then when are you going to do that? But you may not have to sell all, but if you're going to be fully invest, you be careful that you're taking a very high risk. Investment basically also balance up with the risk. My approach is that actually you look at ASEAN, you look at Taiwan, Korea, even India. The economic growth rate this year is still there. Yeah, but you also want to evaluate carefully. There are many undervalued stocks, but sometimes undervalued, you go further undervalued. So, of course, we are Asian. We know Asian market well. So I think maybe we are more comfortable. We will want to stay in Asia, but especially China has dropped so many years in a row. And China actually, if you take a look at the market PE, China market PE is actually quite low. We are talking about half of US easily. But does it mean that they are all half as efficient as the American? It's quite tricky, You buy the share, it will go up. And then the interesting part is that US playing that his interest rate is high, and a lot of people will want to park there. China is more interested on employment, control inflation, so they don't want to increase their interest rate. So your interest rate is way below US. But similarly in Malaysia, if you're going to give 3 month money, 3% and US going to pay 5%, yeah, where's the money going to go to, right? Yeah. So, but US is also, it depends in the long run, how is your strategy. So in short, I think US is not cheap. If you are a cautious person, you definitely don't want to be fully invest, because if you fully invest, if the market corrected, you get hurt so badly that you actually, second move is that you don't have the cash to buy any share. You are really caught very badly. That's why we keep on saying this, that you never fully invest at all times. So when it was high, you should reduce your exposure. You may not done so well compared with people who are fully invest and they read the market right. But, you be careful. You cannot read the market right all the time. So at this stage, I'm very selective. I'm very comfortable with the growth of ASEAN, Asia, but you also need to be selective. Just because the share drop, you also want to study. That's my advice. Because US is the most influential market. You can say what you want. Particularly today, Dow Jones is 32% higher than just before it crashed in 2020. That means I take the February the 12th. You are 32% higher than that, Dow Jones. Aren't you a bit concerned? Yeah, so I hope I should stop here. I think Rajiv may give a better answer. Okay, Rajiv. Hand to you. Is it okay? Are you? Maybe we will answer some of the question. But my cautious is that economic growth rate ASEAN, Asia and Japan are still very reasonable, higher than US. But US is on the high side. So I'm not saying that all US are no good. I just give you one example. Tesla is selling at 64 PE. What is BYD? BYD is below 13. Yeah. Then what's Toyota? Toyota is 10. Then what is if you follow this other Hyundai is also not selling that high. 10 around there. Yeah. So some other like Li Auto maybe a bit high because they're on a premium. Yeah. Hyundai is actually also selling a very low PE. I think Hyundai is around 5-6 only. So you were saying, the way the world is not fair, but that's precisely investment is an art. We are all guessing. all the title I have, you just know that you're lucky, lucky, Okay, I stop here. Razif, I think you can take over and help out.
Yep.
Is
Dr.
it okay?
Tan, yep. Dr. Tan actually shared a lot on valuation, and just now Mr. Ang also shared some on the economic demographics on the US, the interest rate and whatnot. Razif, apart from that, do you think there's any indicator in the US market that investors should stay watchful, and whether you think like US market is really a bubble?
Hi. Okay. I'm kind of leaning towards Dr. Tan's evaluation on the US market as of currently. If you can see, the US market basically gained a lot in 2023. If I'm not mistaken, Dow Jones was up by 16%. S&P 500 was up by 26% last year. Now, like Dr. Tan has mentioned previously, it's all down to valuation itself. And I would personally think that in the US, the risk is more towards the downside rather than the upside. Personally, for me, I would lessen the exposure in the US market and probably going towards the ASEAN ex-Japan, probably ASEAN 5, Malaysia, Singapore. In terms of the US economy itself, sorry, I think we could probably see higher for longer kind of interest rate environment going forward. The possibility of rate cuts was reduced from 6 times to, if I'm not mistaken, 3 times in 2024. And this could well probably be in the second half of the year. I think the good performance in the US market is partly driven by the ETF inflow, whereby when people buy ETF, then fund managers will have to buy the stocks. And same goes with China. For example, if the outflow from the ETF, China ETF, then the fund managers would have to sell China stocks. Hence, the process continues. I do agree with Dr. Tan. We should be looking at this part of the region, ASEAN 5, China, India, whereby the GDP growth target is quite high for 2024, and valuations are very decent as compared to the US. However, to have no exposure at all in the US also is also a risk. Hence, you should have some exposure, but I think investors should be looking out at this part of the world, especially in the ASEAN 5.
Yep. Thank you, Razif.
I think just want to add what.
Yep.
Yeah, sorry, moderator. Just one last to summarize what Dr. Tan and my colleague Razif has mentioned. So the key thing is that there's a few heuristic in the market, more like a saying in the market that it's not a sin to take profit off the table also. So don't because the stocks is going up, right, and let your profit run. It's okay to take some of the chips off the table as well. The second thing is that always look for diversification. I mean, it's never having a benefit in terms of having a concentration in one market or two markets, because you might not know what will happen to the market itself. So you want to never put your eggs in one bucket as well. So it applies to our investment principles as well in terms of diversification and also having a dry powder to able to diversify as well. Over to you. Thank you.
Yep. Thank you, Mr. Ang and Razif. Since we are on the topic of diversification and asset allocation, remember beginning of the year, the investment thesis is that the emerging market equities generally exhibit better performance during periods of weakening US dollar. But this round, we see in January and February, the DXY index still elevated. The expectation of rate cuts now have already delayed, and that also means the interest rate could stay high for longer and hence stronger dollar. So is it a good time, Mr. Ang, to look at the emerging market equities right now, or we can actually wait for better entry point to enter the market?
It's good time to look at emerging markets. In fact, if you look at it right now, the timing to enter emerging markets versus 1 week later, where maybe you ask me again in 1 month later, I would say that it's always a good time to enter emerging markets. But the timing itself, right, you have to look at more of in terms of diversifying your entry levels, because emerging markets has been much under back then in 2023. I mean, because of high interest rates from the US, so causing a lot of fund flows out from emerging markets and into the US markets, which is higher yielding anyway, right? And because of the China issues, right? China is a big weight in Asian index, right? So basically is that there's a little bit of rebalancing in terms of the flows out from emerging markets. But if you see that certain emerging markets, especially the Latin American, has been generated a good return itself, right? So basically is that if we tend to look at the other side of the world, though it may not be familiar with us, right? But maybe we can look at somewhat of ETF level to enter, just to get a broad sense of how the market is, and before we look into company specific, right? So basically is that market, right, especially the Mexico, the Brazil, right, has been doing really well over that side of the world. And over this side, right, because most of the major industries are ex-Japan, right? So right now, Japan is the most valuing in the market among the emerging.
Oh, shit. Are we okay? Mute internet. Sorry.
So really,
Sorry,
you don't want
I
to
think
catch a falling knife as well. So better, it's for this kind of big markets, right? Because China is like a forest, it's like huge forest. So you have to look at very detailed analysis of each companies after the blow-ups in local government financing vehicles, the property side of it. So in China market, right, familiarity and understanding of the local companies itself is very crucial. And not all companies that is state backed are truly state backed anyway. All ratings for the local ratings for the Chinese companies are usually high grades. So 90% are all investment grades. So better be careful on China markets. That's what I'm trying to aim here. So all in all, it's good. Anytime it's good to enter into emerging markets, but don't apply a big bang like what Dr. Tan has mentioned. Always leave aside a little bit of cash so that you can not only diversify in terms of your markets, but also you diversify in terms of your entry level.
Yep. Thank you, Mr. Ang. Dr. Tan, do you agree with Mr. Ang's assessment whether we should actually look at the emerging market equities right now, and whether we should position right now, or we can actually wait for a better entry point? Hi, okay. Sorry, Dr. Tan, you muted yourself. Dr. Tan.
Sorry.
Yeah.
I say it's always very difficult to work for perfect timing. Everybody want to do that, but it's difficult. So in some sense, a bit of wisdom, a bit of not too overweighting on any sector, any country is always quite good. Because in the long run, let me explain something simple. A fund manager only need to outperform the fixed deposit, and the inflation. You know, it looks so simple. Of course, inflation is tricky. Inflation don't go up to a very high level every year. Once in a while they come. So, but on the average, I'm saying that as long as you outperform the fixed deposit and the inflation on the average, you should be able to survive. But can you believe that a lot of fund managers can't even do that? So why are you taking such high risk? You know, you don't want to do that. You know, I mean, sorry, I sound like I'm underestimate all my competitors. I'm not doing. I'm just saying that you'll be so surprised. You only need to outperform these two in the long run. You survive. Yeah, and many people somehow what they do is that when it goes up, they go and chase. They buy very high, and when it go down, they are supposed to put in back the money. They redeem. So that's where the problem is. And then they come and redeem when it was very bad, right? Then they say, well, your performance is so bad, this thing. You want to redeem, you actually want to redeem at a better time, So actually, I'm quite sure all the fund manager will understand what I'm trying to say, yeah. So, okay, I want to add a little bit more points, since you asked the question just now, particularly on the interest rate of USA. USA at the moment, very advantaged. They to some extent, also risk taker. Their inflation is already quite high when the currency is so high. Now, if the currency weaken, the inflation will go up, and US will have a lot of problems, you can see they already have some riot and all these things, So US want to stay high. The minute they lower down only, the currency will go down. If the currency go down, you cannot control it, the market will collapse. So they will have a lot of problems. So, but by staying high, they somehow at the moment, maybe temporarily, have an advantage over ringgit, has an advantage over renminbi, have an advantage over so many countries, So fund management or investment is also very psychological. One day, if people lost confidence in US dollars, I think US will have a lot of problems. That's why you don't want to wait until then. You want to diversify a bit, and you don't want to put such a high expectation. Yeah. So that's why I give myself very low hurdle, right? Only inflation, only fixed deposit, Yeah. Okay, I hope because while we were talking, right, we talk about interest rate, we talk about market, so I like to say a bit that, maybe when we were talking, we overlooked something. On the interest rate side, I think US really has that advantage. And how long can they last? Their debt level is very high. But to be fair, you turn around, Japanese debt level also quite high. They are not low. Yeah, their expectation is so low, and in the long run, maybe it's also not good for them. But now they are record high again. But look at their currency. Their currency is weak, So that's why they basically wash away their debt through inflation, Yeah. Anyway, I will stop here. Yeah.
Yep. Thank
See,
you.
very Razif want to add.
Yep. Thank you, Dr. Tan. Razif, would you like to add anything or your thoughts on the emerging markets?
Okay, I think Mr. Ang, my colleague Mr. Ang and Dr. Tan probably have covered a lot. But again, I would like to reiterate that I do agree with Dr. Tan. Exposure in the US is, for me personally, is risky as of the current moment. And as I mentioned earlier, we should be looking at this side of the region. Probably, okay, China. If you say China, there's some risk there. There's some concerns on the government, on the data presented, of course, fine. But we do have other options. For me, Malaysia, Indonesia, Thailand, Vietnam, it seems like a good place that we can look at to generate alpha. If you can see, if I'm not mistaken, both IMF and the World Bank expect a very good GDP growth for this ASEAN 5. And the valuations are very decent as compared to the US. Again, like I mentioned, the market drivers, I think for last year, at least for the last few years, was the influx of ETF money into the US. So it keep growing. And once this money stops and start to basically roll back, and then we can see steep corrections. This is me personally, of course. steep correction from the US. And we can see this money need to be somewhere else. And hopefully will come to the emerging markets lah.
And maybe I can support you a bit. You see the way US market to the investor, they are showing you that okay, the last 10 years, you know how well we do, and we can continue the next 10 years. So what they do, they go and sell this ETF to the public based on the past performance. And if you are a very value investor, you know your past. That's why they force you to say the past got nothing to do with future. But that's what they do. So they have been able to successfully, I think, collecting all this long-term money. Then every time the long-term money come in, you just go to the index. So it can, whether you're 22 PE, 25 PE, you know, they buy, you know. So you buy the share, it goes up. To a great extent, I actually quite agree that, you know, this ETF actually is supporting the market in a very big time. I'm just guessing. At some point, I'm wrong. at a lot of time also, we should be correct. Thanks. Sorry.
Yep. Thank you, Mr. Razif and Dr. Tan. And since we are on ASEAN, as per our last check, MSCI ASEAN Index trading 1.6 standard deviation below the 5-year mean is a very depressed level. But within ASEAN, maybe we can ask Mr. Ang, then followed by Dr. Tan and Encik Razif. Within ASEAN, are all countries or markets investable, or is there any ASEAN market that we should avoid? To recall, last year, Thailand actually down by about 15.2% in 2023. This year, Thailand, whether the market has already stabilized, whether it's a good time to enter, and maybe we can also talk about Indonesia, right? The election result seems to be a market-friendly outcome. So whether it's time to look at these ASEAN markets, Mr. Ang?
Yeah, as my colleagues here, my fellow panelists here, Dr. Tran and Razif has mentioned, there's no secret sauce to when do we enter the market, right? So basically, in terms of identifying which markets to enter, I mean, just based on my old experience, that the first thing we see is how deep is the market in terms of the liquidity depth. I mean, because we don't want to go into a market with only like 10 stocks that constituents that compose has the major index itself, because you don't get a lot of diversification there. So basically, you want to look at markets that has very deep liquidity and also a developed market as well. So basically, it's like Singapore, Malaysia, some bigger markets like Indonesia, Thailand. It's some that these markets has that kind of depth to at least allows you to exit if the market turns. I mean, the most important thing is everyone can enter into the market. We always like to say that the door to enter the market is very wide. But when it comes to an exit, right, when there's a sentiment change about that market, right, the exit tends to narrow down, like at least in the Wonderland, the doors start to shrink smaller and smaller. So basically, if you want to look in a market, right, that has a lot of depth, quite a developed market, and in terms of currency-wise, right, you don't want to go into certain markets that has high capital control or a lot of reporting requirements for you to enter into the market. And in terms of some of the markets like India or China, familiarity also helps a lot, because the key to understanding the market is quite crucial in terms of understanding the regulatory, because you cannot go into a market without understanding the playbook of that market itself. You need to know the regulations, you need to know about the compliance, and also who are the major players in that market as well. I think Dr. Tan and Razif, my colleague here, may add into my additional points here. But this is looking at depth and looking at the liquidity, and make sure that you know that anything happens, you are able to redeem, you are able to liquidate, and you are able to freely move out your capital. That is the most crucial point when I start to analyze in different markets.
Okay, thank you, Mr. Ang. Any thoughts, Dr. Tan?
I think it's clear-cut indications that Mr. Ang managed very big fund. So when you invest, liquidity become very important. Now you can buy, you buy the share, it goes up, help your valuation. But when the crisis came, you can't go out. Yeah, so that is the biggest weakness of actually ASEAN. ASEAN are somehow not so liquid. You take a look at Vietnam, you last year Vietnam, when things go against them, it just collapsed. Vietnam, best economy growth rate, minus 36%, it's quite bad. 32 and US dollars, why I think they were down 36. Shocked everybody actually, because the liquidity is not there. Malaysia is interesting. You take the National Day, August 31st, go back 10 years. Your KLCI is flat. There's nothing there, But why still people make so much money? Yeah, like you say, Razif, you have alpha. So, but if you're a smaller fund, you are more advantage because you can do that. You can turn, Yeah. So I think liquidity, I totally agree, is important. So you must weigh among your fund size and the counter that you're going to go in. A lot of emerging star is there, but not so liquid. So ASEAN, you can see ASEAN very selective. There'll be new star coming up. Yeah, like Indonesia, they are big, right? Indonesia has a few AI company, a few software company, and all this, and they can jump on the share. But if you don't go out, you notice that the share are down 60-70%. So selling become very important. Yeah. So ASEAN higher economic growth rate. Although you say that you observe carefully. 2023 Singapore economic growth rate is only 1.2. And your Thailand also so weak. And Thailand was only about 2.5. The rest of the ASEAN has done well. They go 5%, 4 or 5%. Malaysia, Indonesia, Philippines. Yeah, we must also be careful. You need to evaluate. And for us, we will go for company that can grow, your software sector, a bit of AI sector, a bit of economy, a bit of EV, a bit of solar. But solar, a lot of shares, the minute you come out, already overvalued. You cannot make money, So you also need to be careful. Yeah. There's so much I can say, but hopefully Rasif can add something.
Yep. Thank you, Dr. Tan. Maybe we can also discuss about this topic on the liquidity because we also noticed that within MSCI ASEAN Index, right, the heavyweights names are actually financials, but they are non-Sharia. And we all know that Dr. Tan and Mr. Razif and Mr. Ang, they have diverse experience in managing Sharia funds as well. So when managing these Sharia funds, right, we cannot actually invest into these financial names which are non-Sharia. So what are the challenges or probably opportunities when it comes to managing Islamic ASEAN funds? Maybe Mr. Razif and Dr. Tan, Mr. Ang can actually elaborate more on this space.
Who's going to go first?
Mr. Razif.
I think you're right.
Yep.
You're right, because when it comes to Sharia fund, you cannot invest in bank. And bank has been, on the rising interest rate, performed very well. So Sharia fund actually has a bit of disadvantage. Then what you do? You go overseas. Last year, it's not the year that you go overseas, you can perform. So Sharia fund at times will perform very well. Sometimes also they have that challenges. The bank is the best perform. You cannot go into banks. At some point when the market crash, you don't go into bank, you outperform. Well, especially global financial crisis. So I think whatever it is, we must manage in accordance to the changes in the environment, you know. So, but saying that, you got to work harder, lah. Yeah. So you still can invest in some of the tech companies, some of the software company, Yeah, but a bit taxing, lah. If you manage a very huge one, you don't have enough stock, So, okay, I think I should stop here because I think Ang may also have some other challenges, Yeah. Okay.
Yep. Mr. Ang and later Razif can actually share more on this perspective. Mr. Ang?
Okay, yeah, this principle-based investing, right? So essentially, is investing according to what you believe in, and beliefs. Our belief systems, right, is very diverse. I mean, it differs from one person to another. So basically, for Sharia investing, yes, in terms of the type of universe and the components of universe investable for the Sharia, right, is limited because of the financial side of it. But we've seen that there's a lot of growth within the Sharia space as well. I mean, because it's mostly driven by the institutional needs, driven by the societal needs, and the retail base that is investing based on their own principles as well. So basically, is that I do not want to say that Sharia has a very limited return. Like what Dr. Tan has mentioned, we need to work a little bit more harder for the Sharia portfolios in terms of generating returns, given the fact that our universe, right, our ability to invest in diverse stocks as compared to a conventional side is a little bit more constrained. But I do see there are more growth in terms of the Sharia idea, especially from where I've seen back a decade ago with the government trying to initiate a lot of Islamic products that is coming out into the market itself. We have the MIFC that previously encouraged the institutional investors to look at overseas as well as Sharia compliant funds. And also we have looked at and observed that there's a lot of sukuk issuances coming up in the market as well. Malaysia is the biggest sukuk issuances in the world. We really outnumbered our GCC colleagues in terms of the issuances. So we are very big in terms of the Islamic side, and the development of Islamic has come with a lot of changes in terms of how we look at Islamic hedging as well. I mean, we have seen that more contracts coming in, like ITMA itself, that is equivalent to an ISTA for derivatives contract. So we have a lot of products that is coming out and releases from the Sharia compliance side. And right now, people are talking about Wakaf. I mean, PTPTN also looking at Wakaf right now has a sort of alternative funding for their educational loan side. So there are very diverse products coming up from the Sharia, which allow us at least to tinker and structure where we can generate returns from these different structures from the Islamic point of view. Maybe my colleague would like to add on, Razif.
Again, for me personally, yes, Sharia funds may have some disadvantage as compared to the conventional funds, whereby Sharia funds cannot buy all these banks, financial companies. But looking at, let's say, domestically, even if in Bursa, I think 80-90% of the stocks is already Sharia compliant. And the actual process that goes into fund management is basically the same, whether it's whatever sector it is. If a fund manager, for me personally, fund manager cannot use the excuse that, okay, it's a Sharia compliant investment, we are quite limited, we cannot generate the income that we need. It goes down towards the process itself. But if you can see globally, even if we take a look at S&P index, all the Sharia compliant index basically outperform the conventional ones. So if we see that Sharia could be a threat or not threat, could be the limiting factor. It cannot, because we do have an array of investment opportunities besides conventional stocks. And domestically as well, we can see that the demand for Sharia products is very well. Hence, most of the products recently launched, I think, is Sharia compliant. But again, it all comes down to the process of investment. Whether it's Sharia or non-Sharia, the process should be the same. And to use Sharia limiting factor for an excuse, it's not right for fund manager to use that as an excuse.
Yep. Thank you, Encik Razif. And since we are on this topic, maybe zooming in Malaysia, we see in January, right? Actually, the KLCI actually up by about 4%, driven by resurging of foreign buying. Resurgence of foreign buying interest into the market. KLCI up 4%, but the small mid cap, of course, there are more Sharia stocks within the small mid cap space, actually up by about 2 to 3%, respectively. So, moving forward, how should we actually, when in terms of managing a Malaysia equity long only portfolio, how should we actually position our investments? Maybe we can start from Dr. Tan, then over to Mr. Ang and Encik Razif.
I think Malaysia, you take a look at the grounds last year. That's very important. Market not so good. Then inflation is there, but they become very, very cheap, particularly in the property sector. So towards the fourth quarter last year, if you notice that a lot of property shares are very, very cheap. And then for some reason, everybody start to believe in that it is so cheap because, if I'm a foreigner, I come and buy your property. Your property already the cheapest in the region, and yet your currency is so cheap. But some people, they complain the other way around. Oh, everything is wrong. You see why it's so bad. Look at the currency. They keep on grousing. So of course, then you practice value investing. You say, why are you complaining when it's so cheap? So last year, I think fourth quarter, if you position yourself, you don't get too smart. You just buy a little bit here, a little bit there. You can actually outperform last year. But they are property. Yeah. Of course, plantation luckily also don't do too badly. Oil and gas also staying there, but not performing that well. Yeah. So the banks also do a bit better. So you need to be very focused in that sense, and if you strong belief of value investing, you have to practice it. But then, of course, the value investing for the first 9 months last year, it doesn't work. The more undervalued, you see the guy go down for them. So I think that's a part that I think I always say this: you are a fund manager, you gotta manage in according to the changes of the environment, and then you have to try to figure out psychologically. Are they going to buy? Are they going to be convinced that that value investing still have room? And property shares, some of them were selling at 0.2 price to book. We cannot find anywhere in the world except Malaysia. And of course, you can say, this is wrong, that is wrong. Yeah. Maybe in short, Malaysia also not so much in debt, but enough for you to buy it, because at the start your bank share perform a little bit, property come in, plantation start creating trouble, and then you have some property to help you. Sorry, I think maybe you have a hidden gem. Okay, maybe I pass to Ang and Razif.
Yes, I really have to concur with Dr. Tan here, and just a further reinforcing statement to what Dr. Tan has mentioned, right? I think more importantly is that investors, right, especially foreign investors, right, they treasure and they look highly on stability and certainty. And basically, previously, Malaysia has experienced a lot of political and policy changes. I mean, we used to kind of like poke around and say that last time one prime minister, four agongs, right? Now one agong, four prime ministers, right? So basically, that certainty has to be in place, right? And it has been reiterated by the recent agong that he will ensure that at least there will be not much changes going forward on the legislative part until the next general election. At least we can anchor based on that by to attract funding flows. But I think importantly is that right now the investors says that yes, you have the stability, you have the policies that you expect to continue on. So what are the implementation next? I mean, that is quite crucial because whatever the policies like NETR, NIMP, and the 12 Malaysian plans, right, all the alphabet soups that comes up, right, will need to be implemented and put into place this year. And it's quite crucial because Malaysia, right, in terms of the public debt, right, the fiscal policy side, right, it has a very limited headroom. Essentially, that because we have been issuing more bonds and borrowing from the public, right? And that has ballooned a lot already. And we have to look ways to see how we can cut down costs in terms of our public services as well. So that would put a little bit more structure and a little bit more anchor in terms of attractiveness to Malaysia as well. So essentially is that certainty is quite important and stability because we don't want to park our money, right, for the long term, right, while we expect 3 or 4 prime ministers to come in within a span of 5 years or so. And this year is a lot of geopolitical elections coming in. We are seeing more than half of the populations are going into the polls. Then one of the survey that we have done, or most of the big houses, research houses has done, is that one of the keynotes in terms of risk, in terms for all investment managers, for us is basically geopolitical risk and tensions. I mean, we have the US elections that is coming in November. We have President Modi that is seeking another term of 5 years. We got South Korea elections coming in. Then we possibly got the EU elections coming in. So all these will come into play. And basically, if we have that kind of stability and we truly implement whatever the NIP and the NETR, everything that we are envisioning to pan out in 2024, then I think we would have more grounds for foreign investors to come in and look into our local markets.
Yep, thank you, Mr. Ang. Thank you, Mr. Ang. Mr. Razif, how should we position in Malaysian market?
Probably I'm going to tackle the question in terms of the allocation of big caps and small caps at it. I mean, how to position itself is a very risk dependent question. It will very much depends on the investor itself. You can see as of end January, the big caps are doing much better as compared to the small caps. Market was doing 4%, the small caps doing like 2%. Of course, when the foreign investors coming into Malaysia, they will definitely go for the big boys, the big caps. Hence, you can see that, I mean, for the past few months, the big caps has been moving like stocks like TM, Tenaga, very safe names. However, for me personally, you cannot go wrong with having some exposure in the small to mid cap as for the kicker to generate alpha for your portfolio. I mean, it very much depends, as I mentioned, if you are a risk-averse person, probably you could go like 80-90% big caps, 10-20% small caps. If you are sort of a risk taker like me, probably we can go like 40% small cap, mid cap, and 60% big cap. But I think when the market goes, all stock will go lah. So basically, the question is which one will go more. Of course, the upside will be on the small to mid cap, but I also do agree with Dr. Tan. Over the long run, your objective should always be to beat the FD rate, to beat the inflation rate. Hence, consistency is the key. You don't want a portfolio, let's say, can be up 30% this year, then down 30% next year. Hence, if it was me personally, I would go like sort of like 60-40, 70-30 kind of weighting, more weighting on big caps. Because when the market move, and my view is for domestic KLCI, FBMS, this year is going to be a better year for Malaysia. Hence, I will probably put a bit more towards the big caps and having some small to mid caps as a kicker to generate the return for the portfolio.
Yep. Thank you, Razif. And since you are on this topic, right, maybe Mr. Ang and Encik Razif can share more on your offerings by Hong Leong Islamic Asset Management, your flagship funds, which is Hong Leong Dana Makmur and Hong Leong Dana Maruf. Then later on, we'll proceed with Dr. Tan from Firm Asset Management to share more on Dana Makmur Firm and other products and offerings. Over to you, Mr. Ang.
Maybe I give way to Dr. Tan first to airwave his film products first. Then we'll do the honor of promoting right after Dr. Tan. Is it okay?
Okay, no problem. I think we basically started small as a house in equity. We actually are not very much in fixed income, partially because I think fixed income, the income is not so good compared with equity. But saying that in the long run, actually you should have both, because your fixed income also has a lot of demand. Okay, so if you look at us, we started as an equity house. We are so lucky, we manage money for Singapore government, and then we manage money for EPF, and then we were the first fund manager also get the European Sovereign Fund. And we were, at the end of the day, that's why we were quite lucky. As a small house, our company is profitable every year for 30 years, rain or shine. As a house, we are also very scared. People say, Chong Kui, you most probably close your shop in 2-3 years. So we were lucky. We survived for 30 years. Rain or shine, we are profitable. Now, we also feel that we should do retail. After 7 years, actually, Dana Makmur started in 2002. And Dana Makmur for the first 5 years or so struggling. And we are most disadvantaged. We are boutique, and then a lot of banks don't want to market our fund. Then towards later on, we start performing. Then one by one, we are more acceptable. The banks are now selling our fund, but still very, very, very challenging. We still have to keep on go to one bank after another, and then go the due diligence will take a long time. Dana Makmur happened to be very lucky. Dana Makmur has performed very well, but at some point you can also not performing well, just like anybody else. But a good fund manager, they will turn around. But once you run into the bad patch, you may take a bit of longer time to come back. But sometimes the challenge, the interesting part, when you don't do well, they should come in, because that's the time from there only you can make a lot of money for them. Yeah. So Dana Makmur is now more than 22 years old. It's very, to me, some acceptability is there. You have a long-term track record. long-term track record has its own advantage. People feel that you may do not so well for a while, but in the long run, you are able to weather through so many crises and then give you a return. Yeah, Dana Magno for 22 years, our simple average easily 20%. So, even your 20 years compounded also will do 6, 7 or more than that around there. So that is very good for people who take extra risk and get a higher return. We specialize in ASEAN, Asia, Japan because also partially like what we are experiencing, we all experiencing because of liquidity. Now, if you don't diversify to other countries, at some point, Malaysia will not do so well. It's the same as anything, You will do very well for a while, and then when you don't do well, then you suffer, So we went to ASEAN long time ago. When we first started, 30 years ago, we already have an ASEAN. Our offshore ASEAN fund is now 29 years, among the oldest in the world. But it has that volatility also. So you have to keep on marketing, Yeah. So we are basically an equity house. We are in ASEAN, we are in Asia, Japan, and even Asia Pacific. All this fund we do, we all done all by ourselves. We don't outsource to anybody. So we were very lucky. Asia, Japan, you underweight Asia, you win your award already. You know what I mean? Because they dropped so badly, while Asia, Japan, we won the award 5 years for 3 consecutive years, and we are homegrown. We are basically equity house, we have diversification in that sense. We have quite a number of officers, My right-hand man in Singapore got 25 years experience, 14 years with Asia, Japan, and in DBS Asset Management for 14 years. Now he has 25 years. My right-hand man in KL also 21 years experience. So we try to diversify so that anybody, if you have long-term fund or you want to have this fund for your kids and all these things, we will be one of them, we diversify for you. Yeah. So we do have some very long-term ASEAN fund 29 years old, Dana Magmo more than 22 years old. Yeah. In fact, our balance fund, Malaysia Emerging, also more than 22 years old. So, but still, we are not Hong Leong, you still have a lot of challenges, but we are not worried about the challenges, because you have this formula, you do value investing. Once in a while, you have problems, Yeah.
For us, right, we also share a lot of commonalities here. Hong Leong particularly is more towards an equity house. I just came in back a few years back to build up the fixed income side and make it more dynamic. We have funds, very long track funds, right, that looks at small to medium caps as well as large cap stocks as well. But our funds are more catered towards very high conviction kind of principles because for us, right, we want to manage in a way that brings value to our investors and value against whatever the investors that is accessible for them to invest in, for example, like fixed deposit and cash. So we want to bring that alpha to our unique holders. And our funds, right, is a testament because of their long track records. They have won several awards. But basically, we cannot rest on our laurel. As I always say, past performance and awards, right, does not guarantee your future awards and your future performances as well. So we have to keep on working hard to generate returns, to generate value for our investors. And our investors with us are investing for the long term. I mean, basically because they have different horizons and most of them are not so very short horizon. I mean, most of the funds that we cater on those short horizons are mostly into money market funds, but most of it are into bond balance fund, macro as well as our equity funds as well, macro, which has a very long horizon, and that long horizon is trying to match with their long-term goals as well in terms of their retirement, in terms of their planning for their future expenses itself. So it's quite crucial for us to look at that areas as well and try to manage and try to meet their goal expectation as well when they invest in our funds, knowing that our funds are more towards a longer term investment horizon to meet their long-term goals as well. So maybe, I leave it to Razif to add on, if anything.
Yeah, hi. So on the Islamic side, we are basically the external fund managers for Hong Leong Asset Management, whereby we manage the Sharia funds for Hong Leong Assets. In terms of equities, we do currently have two funds. One pure equity funds, which is Dana Makmur, and the other one would be a mixed asset fund. It's called Dana Makruf. It's about 60-40 kind of exposure towards equity and fixed income. On the fixed income side, perhaps BK would like to mention what are the products that we offer.
Yeah, some of the fixed income products, especially those to cater for investors who value regular income streams and stable income distribution payout, right? So we have our Islamic Income Management Fund and also SAFA as well to meet their streams of income requirements as well. So basically, these are more towards a bond fund that looks at more stable and strong credit names. And for Hong Leong, I'm also proud to say that because we have very tight credit evaluation and assessment, so we are very mindful of the defaults and all those bankruptcies related. So we only look at really high grade companies and credits, not on the high yield side of it. So yeah, that is to assure our preservation, our capital stability for our investors.
All right. Thank you, Mr. Ang, Encik Razif, as well as Dr. Tan for their insightful sharing. And just to share with you, you guys, all the participants, not to confuse with Hong Leong Dana Makmur and Dana Makmur Firm. So basically, Dana Makmur Firm is a mixed asset funds with exposure in Malaysia fixed income, Malaysia equities, as well as foreign equities, including exposure in ASEAN as well as Asia Pacific and Japan. While Hong Leong Dana Makmur Fund is a pure Malaysia equity funds, right? Investing into large cap and small and mid cap space in the Malaysian markets. So these funds are not only Hong Leong Dana Makmur, Hong Leong Dana Makmur, Dana Makmur Firm as well. There are a lot funds available on our Phillip Mutual Berhad as well as e-Unit Trust platform. So we would like to express our sincere gratitude to Dr. Tan, to Mr. Ang, and Encik Razif for their time with us. Thank you so much for joining our Phillip Roundtable, and we'd also like to thank to our participants for your continued support to Phillip Capital Malaysia. Stay tuned for our next Phillip Roundtable. Thank you so much.
Okay.